What if I told you that one of the biggest financial decisions you'll ever make isn't which stock to buy or which house to flip, but choosing stocks or real estate as your starting point? Both have created millionaires. Both can also cause beginners to lose money fast. So, which one is actually better for beginners?
Welcome to the Financial Frame, where we break down finance and invest into simple, understandable ideas.
Today, we're breaking it all down. Stocks versus real estate. The pros, the cons, the risks, the returns, and most importantly, which one makes more sense when you're just starting out. By the end of this video, you'll know exactly which path fits your situation, even if you have little money or zero experience. Let's get into it. What are stocks? When you buy a stock, you're buying a small piece of a company. If that company grows and becomes more valuable, your investment grows too. Some companies also pay dividends, which are cash payments just for owning the stock. Stocks are usually bought through apps or brokerages like Robinhood, Fidelity, or Vanguard. Why beginners are drawn to stocks? You can start with very little money. It's easy to buy and sell. You don't need to manage anything physically. Everything can be done from your phone. But just because stocks are easy to access doesn't mean they're easy to master. What is real estate? Now let's talk about real estate. Real estate investing usually means buying property, like a house, apartment, or duplex, and making money from. Rent, monthly cash flow. Property appreciation, value going up. Tax benefits. Unlike stocks, real estate is a physical asset. You can see it, touch it, and control it. Why beginners like real estate? It feels more real and tangible. You can use leverage, borrow money. It can create monthly income. Historically, it's less volatile than stocks. But real estate also comes with responsibilities that stocks don't. Cost to get started. This is where the difference becomes very clear. You can start investing in stocks with $10, $50, or $100. Some platforms even allow fractional shares, meaning you don't need to buy a full stock. There's no down payment, no closing costs, and no maintenance. Real estate usually requires a down payment, often 3% to 20%, closing costs, inspections, repairs, emergency reserves. Even with beginner strategies like house hacking, most people need thousands of dollars to get started. Stocks are winner for beginners with limited money. Risk and volatility. Risk is huge, especially for beginners. Stock prices move every single day, sometimes dramatically. Beginners often panic sell during market drops, locking in losses. If you pick individual stocks without research, you can lose money fast. However, long-term investing in index funds has historically performed very well. Real estate prices don't change daily. It's generally more stable. But the risks come in different forms. Bad tenants. Vacancies. Unexpected repairs. Market downturns. High debt from mortgages. You don't see the price change every day, but the risks are still real. Stocks feel riskier emotionally. Real estate is riskier financially if done wrong. Time and effort. Let's talk about how much work each one requires. Stocks are mostly passive. You research. You invest. You wait. Index fund investing can literally take a few hours per year. Real estate is more hands-on. Finding deals. managing tenants, handling repairs, working with contractors, dealing with legal and tax issues. You can hire a property manager, but that reduces profits. Winner for beginners with limited time is stocks. Cash flow versus growth. This is a major difference. Stocks are better for long-term growth. Your money compounds. Dividends can be reinvested. Best results over 10 to 30 years. Real estate is better for cash flow. Monthly rental income. Rent increases over time. Mortgage gets paid down by tenants. If you want money coming in every month, real estate wins. If you want to grow wealth quietly over time, stocks are powerful. Leverage, the double-edged sword. Leverage means using borrowed money. Stocks. Most beginners don't use leverage, and that's a good thing. Real estate heavily relies on leverage. You might control a $300,000 property with $15,000, $30,000 down. This can multiply returns, multiply losses. Leverage makes real estate powerful, but dangerous for beginners who don't understand cash flow, taxes, and benefits. Stocks. Capital gains tax when you sell. Dividends may be taxed. Tax-advantaged accounts like IRAs help a lot. Real estate. Depreciation can reduce taxable income. Write-offs for expenses. 1031 exchanges allow tax deferral. Real estate has more tax advantages, but they're more complex. Which is better for beginners? Here's the honest answer. Stocks are better for beginners if you have little money, want low stress, have limited time, prefer simplicity, want passive growth. Real estate is better for beginners if you have capital or good credit, want monthly cash flow, are willing to learn actively, don't mind managing problems, want leverage and tax benefits. The smartest move? Many successful investors start with stocks, build capital and knowledge, and then move into real estate later. You don't have to choose one forever. So, stocks versus real estate. There's no universal winner. The best investment is the one that fits your life, your goals, and your personality. If you're a beginner, start simple. Start learning. Start investing. If this video helped you, hit the like button, subscribe the Financial Frame channel for more investing content, and comment below. Are you team stocks or team real estate, and why? Thanks for watching, and I'll see you in the next video.